If it is private, then you see limited. So the only thing is that it has no numbers of shareholders can be infinity. That means can be more than millions of shareholders, but that of public is restricted. So public company allow public to subscribe for their share, and then their share can be transferable, can be marketable from one person to another. 3 people, you can sell their shares, and any other person can buy their shares at the end of the day. Now, what are the features of a public company? What are the features of public company? The word public must be stated in the memorandum. The word public must be stated at the end of the day. Then, it does not restrict the right to transfer its share. It does not restrict the right. That means they don't restrict them to transfer their share. They can transfer their share unlike that of a private company. Then it must publish its annual account. That is public company for you. It is possible. It is imposed on them by the CAMA to publish their annual account at the end of the day. They must publish it and put it in the newspaper. And that's why when you check the newspaper at the end of the year, you see the financial statement of some company. You could have known that that company must be a public company. Then its shares are quoted on stock exchange, and stock exchange, they deal with securities, share stocks, and many other things. So their shares must be quoted, must be stated in the stock exchange. And when you look at this paper, you see the activities of the stock exchange. The only thing they do in the stock exchange market is they deal with securities like share stocks, bonds, and the like. So the next one is it must be formed by at least 7 people, but no limit to number of shares. That means from 7 to infinity. So public can have as many numbers of shareholders. They can have as much as millions, billions shareholders that are owner of the company. That's why it is called public company. Now we'll be talking about the differences between private and public companies. What are the differences they have? Number 1, private company must, by its article, restrict the transfer of shares, while private company can transfer, a public company can transfer its share at any time. They are not restricted to transfer their share like the private company. Then the next one is membership of private company is generally limited from 2 to 50. That means the people that can own the private is range between 2 to 50 people. But public company has minimum of 7 and maximum, and there is no maximum. Like I told you, infinity can have as many shareholders, many owners of the company. Then the next one you have, in private company, the public is not allowed to subscribe to its share, but investment public can subscribe to the share of public company. So in private company, they can subscribe share internally. They don't allow members of the public to subscribe for the share, unlike the private public company. The private company is owned and controlled by the owner, but public company is owned by shareholders and controlled by the board of directors. That is a segregation of duty. A shareholders are the owner, but they put the board of directors in control to man the business. To direct and control the business. So, and it is the board of directors that will be accountable to the shareholders at the annual general meeting. He will tell them the profit that they make. He will tell the shareholder that this profit we make at the end of the day, this is our target, this is so, and many agendas that will arise, that is likely to arise in the general meeting. So it is owned by shareholder and it is controlled by board of directors. Then the 5th one is public company shares are not quoted on the stock exchange, but public company are quoted on stock exchange. So private company are not quoted on stock exchange, while public companies are quoted on the stock exchange. Then the last but not the least, it is not mandatory for private companies to lodge its audited financial accounts with CAC. So if they like, they can prepare financial statements. If they don't like, they prepare, but it is not compulsory for them. They can prepare it because it is necessary, but it is not it is not imposed on them to lodge their financial statement to CAC. But it is mandatory, not voluntarily, for the public company. They have to lodge it with the CAC because CAC must monitor their activities, and they under the regulatory activity of the CAMA. So that is the differences between private and public company. Now, the topic 3, we'll be talking about the quoted and unquoted companies. Quoted and unquoted company. So, quoted company is a public company whose share can be bought or sold on the stock exchange. So, their shares are, there is a dealing in their shares on the stock exchange. So, we have examples of them: Unilever, NECO PLC, Niger Insurance, Access Bank, and many. We have First Bank PLC. We have many that their share is quoted in the stock exchange. And stock exchange is a commission whereby they deal with shares of a company, whereby the value of their share is being quoted in the stock exchange. So many people can buy shares in stock exchange, and they can also sell their shares. That means if you have shares and you need cash at the point in time, you can easily go to stock exchange and you contact the jobbers and the stock brokers. Those are the people that they deal with shares. They are the consultants, so they will help you to get in touch with some people that are ready to buy the shares, and you easily get your cash at the end of the day. So that is the dealings they did, dealings of security. They do that is the activity of the stock exchange market. And we have Nigerian Stock Exchange, which has the headquarters in the Lagos. They have branches also in the states. So we have the features of a quoted company. What are the features? We have a marketable of shares. Their share is marketable. In as much the share get to the stock exchange, then the share can be marketable. So then collateral security is put in place. Then realization of cash through sales of shares. You know, I told you the other time that the shares can be marketable, and when share is marketable, that means you can realize cash. That means new shares and the existing shares. That means if you have a share now, you have a share for a very long time. It is called existing shares. It is old share, not new share. So you can take it to stock exchange and you can realize money through that. So easy valuation for purpose of capital gain. It is if your share is quoted in the stock exchange, then it is the valuation. Can easily get value for your shares. That means market value of the share at the end of the day. So it helps in computing the capital gain tax at the end of the day. Now, quoted company. Quoted company is also a public company with the issue share of stocks that are not traded or quoted in the stock exchange, but are traded. The shares can be traded, but it is not quoted in the stock exchange. That is there are some companies like that they are public company, but the shares are not traded on the stock exchange. And government has been taking some necessary measures in order to handle those people and in order to make their shares available in the stock exchange. Example of those companies is MTN Telecommunication and many other companies like that. So we have the features of unquoted company. What are the features? That their share is traded in a very low volume, and they trade shares with few people. They trade shares with only few people, and that are the features of unquoted company. So what are the differences between quoted and unquoted complaint. What are the differences? Though they are public complaints, but they have a little bit differences. And the difference is that shares are quoted on the stock exchange. That is for the quoted company. But shares are not quoted in the stock exchange. That of the unquoted, of their shares are not quoted, but the trade share, but their shares are not quoted in the stock exchange. Then we have shares that are traded in large volume. The shares of quoted companies are traded in large volume, while the shares of unquoted are traded in a very low volume. Then the next one is loss of privacy. In as much your share is being traded in the stock exchange, then your privacy will be tampered with, because many people will know the market value of your shares, and they will know the number of shares that you have, because or any information that requires the company must be submitted to the stock exchange. So, but that of unquoted, the security is not loose in quoted, so they don't lose privacy because their share is not quoted. In as much your share is quoted in the stock exchange, then it becomes attractive to the public. So then the next one is exposed to takeover by other companies. When the company sees the true picture of your company, because you have to submit necessary information that have to do with a quoted company. So some companies can take it as an advantage for them to take over that company, because by exposing the company to stock exchange, it will expose their weakness, expose their strength, and many other things. But the reverse is the case in the unquoted company. So their share, they are not exposed to takeover. So that is the differences between the quoted and the unquoted company. Topic 4, we'll be talking about the financial system. And that is a very paramount topic that we must be very careful, because that is the what brings about company. That's